But the point of that is structuring, flexible exits, not just, okay, this is what we're hoping for, this is what we're planning, we're going to get debt to match that. You do have to consider that, but you also have to consider, well, what if the debt markets or just the transaction markets aren't what we plan on? You don't want to be trapped, right? You want to make sure you structure your debt so that you can exit favorably almost no matter what.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Andrew Cushman. Andrew's been on the show a couple of times in the past. We were both at GoBundance, and it was just an honor to meet him in person. But to have him on the show again, he is just an amazing operator, just a great guy. And I love having conversations with him. He was on show 100 and also 592. I would encourage you to go back and listen to those episodes. But, Andrew, he's a former chemical engineer and who found his entrepreneurial calling in real estate. In 2007, Andrew left his corporate position to start a business in real estate. He started off flipping single-family properties in Southern California. Sensing a shift in the market in 2011, Andrew transitioned to multifamily acquisitions and has successfully syndicated and repositioned over 2,300 multifamily units. He is a frequent guest and panelist on real estate podcasts, educational forums. Recently launched the Multifamily Accelerator, and it's a mastermind group for active and experienced real estate investors. I just enjoy a conversation with Andrew. I mean, he goes through some specific deals and talking about even team building, talking about a fire that burned down an entire building and different things. From exit plans to pricing the market right now to a Harvard study that he likes to see. Whether we're talking about population growth or median income. And he goes through so many different things during this interview that are going to be so helpful to you as an operator, whether you're a passive investor or an active operator. You're going to learn a lot from Andrew today.
We are back at GoBundance. I'm thankful to be doing some interviews live this week. And it's interesting. I know lots of people that are here and some returning guests. And I love catching up with people just like our guest today who is crushing it in multifamily, Andrew Cushman. Andrew, welcome back to the show.
It's good to be back and actually get to meet you in person this time.
This is great. Andrew was our guest on show WS 100, believe it or not, and then WS 592. Some great shows. He has added so much value to you as a listener and myself already. I'm looking forward to this discussion today. He's definitely somebody that I look up to in this space. And today we're going to go into choosing proper debt and thinking about how does that align to your business plan or your exit plan or different aspects of your business and thinking strategically about that with numerous other things of how he's operating right now in the current economy and the state of the economy. So Andrew, get us started a little bit, though. I know the listeners have heard a little bit about your backstory, getting into real estate and former chemical engineer and some of that background. However, give us an update on this past year or maybe the past year and a half or so. What's been happening with your business? You're buying, selling? Have you just been on hold? What have you been up to?
Yeah, it's been an exciting year. About 2.5 years ago, I finally corrected the mistake of not hiring on some more A-level people. So we added to the team a couple of years ago, and both of the people that we've added are better than I am at their respective aspects of the business, and that's really borne fruit this year. When as of this March, we'll have acquired $108 million in apartments in a 12-month period, which is for us by far the biggest year that we've ever had, and that puts us about 2,600 units, and we're really excited. Those deals, even though they're early, they're doing really well, and it's been a really exciting time to be in the multifamily business.
Wow. A couple things there quickly. You recently hired some people that are better than you are at those respective things. What were a couple of those things, or what are these people focused on that you recently hired for?
Perfect example is, so you and I today are sitting here at a GoBundance conference, right? Well, at the same time, the National Multifamily Housing Conference has been going on in Orlando, right? And that's where 8,000 owners and brokers all get together, and it's like speed dating networking, right? You meet with a different broker for 20 minutes, 20 of them in a day, and then you go to the after party and all that. For me, I do it and I can do it, but that's kind of draining. Anthony, our acquisitions guy, he gets energized by that. He's really good at that. Just naturally, he'll be having breakfast or dinner with brokers 3, 4, 5 times a week, right? So I can do it, but he can do it better because, again, it energizes him. He's got the personality. He's likable. He's smart and all that. So he's at NMHC right now doing what he's best at, and I'm here doing other things that I'm better at, and that kind of divide and conquer almost is part of what's really allowed us to grow substantially in the last couple of years. And, I'm, as you mentioned, I'm a former engineer. I've always been a deal guy, always an analytical guy, but what I really had to learn, and I was slow to the game at, was the business building and the team building. I did way too much myself for too long, so.
And we're not going to spend a ton of time on this because we could do a whole show on team building and hiring A-class talent, those things. But when did you know that you were ready to hire an acquisitions director?
I'd say about 3 or 4 years ago is when it finally dawned on me. I really should have done it sooner than that. Because again, I made the mistake of thinking, well, no, it's me. I'm the best guy at this. It's my name. It's my reputation. And that part is true. But as far as the name and reputation goes, but the false mindset was that it literally had to be me. It's like, no, I can add this person to my team. And when he's talking to people, it's like, yeah, Andrew and I work together, or here's our company. And so, yeah, someone else could do that without me literally dialing brokers for 6 hours a day.
I can completely relate. We're in the process of hiring. We just hired a full-time asset manager, fixing to hire an acquisitions guy. We should have done it before as well, and we're not as far along as you are. But $108 million, what was maybe the biggest challenge? I mean, $1.8 million, 12 months. I know a lot of the listeners thinking, oh man, this guy, Andrew, he's so far ahead of me. I can't even imagine doing that. Give us 1 or 2 challenges maybe that you had to overcome when doing $108 million in 12 months.
A few years back, I couldn't have imagined it either. Right. I mean, when I started this business 10 years ago, if you had said, hey, you'll do $108 million in a year, I'd be like, no. That's other people. That's guys in suits in penthouses in New York, not some dude working out of his house in California with a surfboard in the background, right? Like that's just, no, that wasn't in my reality. The challenges of doing it today is finding the deals, the ones that pencil out. Everyone knows that multifamily has performed well and probably will continue to perform well, and there's a ton of capital looking for yield. So I'd say our number one challenge in any size, whether you're looking for 10 units or 150 or 350, is finding those deals and creating the processes to sift through all the bad ones to find the good one, and having the discipline to wait. It's especially when you're beginning, that the eagerness to get the first deal. I mean, it's palpable. It's real. We're averaging having to sort through 200 properties to buy one, and that it's tough to do that, but it pays off. So the biggest challenge is finding the deal right now.
I just appreciate you highlighting that. Hey, not too long ago, you would have said, hey, that's not me, which is probably what many of the listeners are saying as well. So just limiting beliefs. I had them at one time as well. Never imagined, where we would be just a few years later. But I want to jump to, just a topic today that we were going to discuss. And I think it's so important, choosing proper debt to match an exit plan. You and I were briefly discussing this ahead of time. And I'd like for us to just jump in. Maybe you have an example that could help us to start thinking about this as well. Maybe a project that you did where maybe one kind of debt may have worked. However, when you considered the exit plan, it didn't work as well. Maybe we can dive in there.
Yeah, I can think of 2 recent examples that are on different ends of the spectrum. So we got a property under contract in December of 2020, which that was the height of COVID winter, right? Like that was, all right, winter's coming, we're all going to die, no one knows what's going to happen. And there's a lot of palpable fear of, what was going to happen to the economy and all of that. And so, that was also the largest property we'd ever bought at the time. It was $49.8 million. And so when we underwrote that, we said, all right, we want to make absolute certain that we have a flexible exit, and almost under any scenario, we're good, right? And bridge loans these days are, I think, 75% of all acquisitions. Well, the problem with the potential issue with bridge loans is they're typically short term, 2 or 3 years, maybe an extension, which, by the way, you have to qualify for that extension. It's not automatic. You can't just say, I want it. You have to qualify for it, right? So we're like, all right, we want to hold this property for 6 years for a variety of reasons, but what if the market shifts against us? How do we hedge against that? And I'll walk through our thought process so that anyone can apply the same logic to a property that they're buying. Again, big or small, the size doesn't really matter. So what we did is we said, all right, if we get a 12-year fixed Fannie Mae loan, that comes with 6 years of interest only, but that part's not really important. So we had a fixed rate for 12 years, meaning the worst case scenario, we could ride that property out for 12 years. But we want to sell it in 5 or 6. The downside of fixed rate debt is that if you sell early and someone doesn't assume that loan, you can possibly have a huge prepayment penalty. So what we did with a 12-year Fannie Mae debt or fixed rate loan, you can get 2 supplementals. And for anyone who's not familiar with a supplemental, that's like the equivalent of getting a second mortgage on your house, right? You get a first loan, the value goes up, and you're like, hey, I'm going to pull out some cash. So the reason we went with that 12-year fixed debt is because it gave us an option of no matter what happened, we should be okay. And I'll run through the options. So let's say interest rates go through the roof and 5 years from now, they're 5 or 6 or 7% on a loan, right? Well, if we go to sell, the Fannie Mae loan is assumable. So we can give say, hey, look, you don't have to get a 6% loan. You can take over our 3.7% loan and have really low cost of debt. Oh, and by the way, the downside of assuming a lot, it means when someone's assuming a loan, that often means they have to bring more equity, right? Because it's typically a lower loan balance. But because of going with that long loan term, you can get the supplementals, which means a buyer can assume the low rate and get a supplemental to get back up to the full 75% leverage. So they get the best of both worlds. They get a low fixed rate and then get up to 75%, right? So that's a favorable exit. Okay, what if we get a few years down the road and values have somehow dropped? Or like in 2008, there is no refinancing market. Like you just can't get debt. Worst case scenario, we can hold for another 6 years at a fixed 3.7%, right? If you look at a 12-year period in U.S. real estate history, it's pretty difficult to find a period of time where an apartment complex is worth less 12 years down the road than it was when you bought it, right? There may be a dip in the middle, but we structured the debt so the worst case is, okay, we can ride through that. Then, by having the ability to do 2 supplementals, if the property does extremely well in the short term, we can do a supplemental and pull out cash and return some of that to investors and have less cash invested. And then when we do let's say we do go to sell in 5 years, let's say by some miracle rates are lower and someone doesn't want to assume our loan. And you say, well, geez, okay, now, Andrew, you're stuck with that prepayment penalty. Yes, that's true. We would have a prepayment penalty. However, if interest rates are that much lower, that probably also means cap rates are that much lower. And the extra valuation of the property that we weren't planning on should more than compensate for the fact that we are now paying a prepayment penalty. So I know there's kind of a lot of technical debt terms that we talked about there, but the point of that is structuring, flexible exits, not just, okay, this is what we're hoping for, this is what we're planning, we're going to get debt to match that. You do have to consider that, but you also have to consider, well, what if the debt markets or just the transaction markets aren't what we plan on? You don't want to be trapped, right? You want to make sure you structure your debt so that you can exit favorably almost no matter what.
I love the long-term fixed rate debt. I just sleep better, right?
Yeah.
But I think also there's this fear around prepayment penalties.
Legitimately so, yeah.
Right? Oh, I don't want that to happen, or somebody can't assume it, or just the prepayment penalty alone. Anyway. But I think 1 or 2 times recently we've sold projects where we had to pay the prepayment penalty, but it was more than worth it to still pay the prepayment penalty. And so I just appreciate you highlighting that. And so on this project, so you say you get it under contract December of 2020, or you closed in December?
We under contract December 2020, closed March 1st of 21.
Okay. So that project, any chance that you'll sell? What's the timeline for the supplementals, or kind of what's next as far as the loans concerned, and how that's going now after you've been into it for a year?
It's going far better than we planned. So we probably actually will be doing that supplemental and holding for the full 6 years. Yeah. It's already exceeded its 6-year target. So, and we expect the growth in that market to continue. So it's definitely going to be a good long-term hold.
Congratulations. That's incredible. So you're going to go ahead and do the supplemental. Explain that a little bit. What tells you it's time to do that? Like, how do you know when you should do that?
That's a really good question. And I can't even think of ever even hearing anyone discuss that. Like, how do you decide how and when to do a supplemental? So part of it, I would say, is how much longer you're going to hold the property. If you're going to sell in a year, it doesn't really make sense to go through the trouble and expense of doing a supplemental. However, if either, if you own the asset yourself or if you have investors, so if you or your investors can put that cash to use somewhere else more efficiently over, let's say, the next 3 years, then yes, it might make sense to go ahead and get that supplemental, pull the cash out. And if that means you can do another acquisition, then yeah, that probably makes sense to do that. Another factor to consider is, the cost of, well, that's kind of similar, but cost of capital, right? So if you're going to do a supplemental and you're going to pay 4% interest on that, well, if you're going to use that money to maybe pay off equity or something else that costs you 7% or 12%, well, that, of course, makes sense to do that. And then also just looking at your total leverage. So when we do supplementals or refinances, we typically only go up to about 65, maybe 70% LTV. What you want to be aware of is, okay, if I do a supplemental up to 75%, Fannie might let you take that to like a 1.25 debt coverage ratio, right? So let's just say your debt is $10,000 a month. They'll say, well, your net operating income has to be $12,500. In reality, that means you only got $2,500 a month margin, right? That's not that deep of a margin on an apartment complex. So it's also your comfort level of, well, okay, yeah, I can get this supplemental. Yeah, I can pull out the money, but it's going to increase my debt burden. And would I, talking about sleeping at night, would I rather just stay low leverage? I'm making great returns as it is. Maybe you just want to stay low leverage and sleep better at night. That's something else to factor in is like, how, if you get a supplemental, how much is that going to cut into your cash cushion? So that if the market does shift against us down the road, how well are you going to be able to weather that with the additional debt? So those are some of the, the timing, what else can you do with the cash, and how does that affect your ability to weather an adverse market?
Appreciate the explanation there. That's some great insight. What would have had to have changed on this property to say bridge debt would have been the best?
That's a great question, and I can actually give another example,
please,
to illustrate that. And this is a deal we closed about 2.5 months ago, where it was late 80s construction, fully occupied. However, a few years prior, they had a fire that burned down an entire building. And when we went under contract, they were wrapping up construction of the new building. So we were in the way it worked out, we got those 20 brand new 2022 construction units for the same price we were paying for the late 80s. So that was a great bump right there. However, Fannie Mae and Freddie Mac looked at that as 10% vacancy, right? Because yes, the existing units are full, but you've also got these other 20 that aren't delivered yet, and so that's vacancy, so you're below the 90, agency typically requires 90% occupancy for 90 days. You might be able to get a waiver to go to 85, but basically it's 90 for 90. So we had to go bridge. So that was a factor where, if we didn't have the 20 new units, we probably would have done some kind of agency financing like we did on the one I just described. But this one, we didn't have that as an option. So that's one where we did go bridge, but we got the longest term bridge loan we could get, and we also lowered the leverage. So we could have got 80%. We went ahead and got 75%, just again, have that little bit of extra cash flow cushion and equity cushion. And also knowing that in a market that has extremely high demand, we know that we can lease those 20 units almost immediately when they come on, brand new construction units. And so we looked at it and said, okay, there's extremely low execution risk on that piece of the value add, right? Their units are here. They're going to have their COs in a few weeks. We'll lease them up in no time. And then once we have, some history on the P&L with that, then we can go and refinance into whatever other kind of debt. So in that case, to us, we felt like the bridge debt was a relatively low risk because, again, we didn't maximize the leverage. The path to getting to the higher valuation and refinancing was very clear. And when we do refinance it, it's a very good fit for all the other types of debt. So that's an example of where bridge definitely makes sense. And again, there's bridge loans out there with very attractive terms, but they're only 1 or 2 years. Well, what if the market shifts and you can't get out in 1 or 2 years? Or what if, your contractors bailed on you and the prices of everything went up and, you're only halfway through the renovation in 1 year, right? Bridge debt does have a use and purpose, but it's definitely to be used a little more carefully. And I would, anyone who goes bridge debt, I would definitely recommend, go with the 3 year plus the 2 year extension. So hopefully at least you have 5 years.
What is Agent Ignite? Are you wondering how you can make more money and create a competitive advantage for yourself and your clients in this ever-competitive real estate industry? Agent Ignite is the key to furthering your knowledge, establishing your expertise, and positioning yourself as a go-to expert. They deliver new and relevant knowledge so you can expand your clientele, close more deals, and ultimately increase income. Each month features a new guest speaker who will deliver on what is most relevant for your business. As a member of DMAR's Market Trends Committee, an avid champion for building wealth through real estate, and a self-proclaimed data geek, Nicole will share market trends and commentary that will add value to you and your clients. Staying up to date on industry statistics, coupled with niche topics delivered by industry experts, will help you motivate your buyers and sellers and make you more money. Sign up for the next Agent Ignite session at theruthteam.com/events. On that note, a few questions about that. You mentioned earlier when we were talking about bridge debt, you have to qualify. Or was that the bridge debt? I was trying to find my notes. Yeah, so you have to qualify. So can you elaborate? How do you qualify? What's an example maybe of not qualifying?
And this is something that when you apply for the loan, it's in the loan docs. They specify, okay, if you get to the end of year 3 and you want to extend the loan, first of all, you got to pay a fee. You know, it might be 25 grand. It might be 0.5% of the loan balance, might be 1%, something like that. And then what they'll do is it's almost like requalifying for the loan again, right? They're going to want to make sure that you have a certain debt coverage ratio. They're going to look at your occupancy. They're going to look at your expenses. And they're literally going to requalify you for the loan. And then if they think that you requalify, then they say, all right, pay us the fee. We'll give you another 12 months. So it's not an automatic thing. And so that is one of the dangers is if you get 3 years down the road and it's 2008 again and the bridge lenders don't want to lend. Well, so in 2020, bridge lenders disappeared. They were gone. You could not get a bridge loan at the beginning of COVID. I mean, the only ones lending were the agencies. That was it, right? So if your loan comes due and you're unlucky enough that it's one of those periods where the bridge lenders disappear, and they do, you're not getting that extension. So that actually comes back to getting the bridge loan is some of those terms are negotiable, right? So they had some stuff in there that we were like, this is ridiculous. Like, I'll give you an example. We pay our property management company 3%. We use third party at all of our properties. Well, they had in there that, well, we're going to use the higher of the actual or 4%. I'm like, no, we pay them 3%, right? And it sounds like a minor thing, but you know, a couple hundred units, an extra 1% management fee, that can make the difference between you qualifying for your loan or not, right? Or even on a 10 unit, right? And so we went through and negotiated some of that out and actually got them to agree to it to make it easier to qualify for the extension if we need it. We don't plan on needing the extension, but again, you know, the first question you should always be asking is, what's the downside? What are the risks? How do I mitigate them? Then if you can either sufficiently mitigate those risks or they're acceptable, then you say, okay, cool, what's the upside, right? But the first thing is, what's the downside? And one of the potential downsides is a lender saying, nah, we're not going to qualify you for that extension. Your loan's due in 60 days, you know? So that's important stuff to look at.
Talk about some sleepless nights at that moment. So why wouldn't the seller have leased up those units before selling this project?
That's a really good question. You know, it's funny. When I look at every deal we've done, it sounds like a 1 in a million deal, but that's what you're looking for, right? You're looking for the needle in a haystack every single time. Every deal is like, oh man, that's so lucky, or how'd you find that? Well, you know, you look at a couple of hundred so that the one that works, it sounds like you totally got lucky, but it's because you sorted through a million of them to begin with. So the reason is the seller of this property, it was a large fund with roughly 15,000 units. This property was a one-off for them. It was the only property in that market. Everything else they had was miles away from it. And a broker that we had a really good relationship with, he had a really good relationship with this owner and was like, we've got a guy who would love this property. Would you entertain an offer? And they're like, yeah, you know, if you can hit this number, we'll go ahead and sell it. And one of the beautiful, guys like us, you and I, we're trying to maximize every dollar out of every property we can, right? Well, one of the things we've noticed is when you're dealing with funds that have 15, 20, 25,000 units, it's a line item on a spreadsheet. If they can just hit their number and exit and recycle that money, that's what they want to do. And so the number they gave us, we were like, really? That's okay, that actually works. I couldn't believe it, right? So basically, it hit their return number, and they said like, all right, well, if you'll still buy it with these units unleased, this number works for us, and we'll just do it. So no one else saw it. No one else got the bid on it. No one else got the offer on it. It hit their number. It works for us, and that's why they were willing. It was all based on relationship. And then just eliminating a headache for them because they got this one property that's hours from everything else, and it had a fire, and it's got construction. It's like we can take that off their hands.
How did you build the relationship? What did that look like?
So the broker is just someone that I've been talking to for years. He saw us buy something. I don't even remember what it was, and because the brokers watch, they're all watching who buys what. And if you buy something in a submarket that they operate in, they'll often call you. And be like, hey, I saw you bought this, because they know you're a closer, right? You just bought something. They know what you like to buy, and they'll be like, hey, well, I got something else like this. So that's how he actually reached out to us. We've been talking with him for a couple of years. So he knew that property would be great for us. And again, another reason I think we actually won the deal is because what he did that a lot of times doesn't happen is he connected us directly with the seller. He's like, hey, here's the guy's cell phone number, talk to him, right? So I got to talk to the actual guy making the decisions to sell and build that relationship. And so now you've got a good relationship with the broker, with the seller, with us, and that's the ideal situation. In fact, our last 3 deals that we bought, all 3 of them, 4. The last 4 that we bought were situations where a broker brought it to us and said, here, you can talk to the seller. And our team worked directly with the seller, formed that relationship, and the seller's like, okay, I like you guys, I trust you guys, let's do this. And we were able to get the deal done.
That's incredible. It goes back to relationships,
every time.
It's just crucial. I just wanted you to hit that. I assumed you were going to say something about relationships, and people ask us all the time, how are you finding deals? Where are you going direct to seller? And I'm like, almost all of them are coming from broker relationships.
Again, for someone who's like, well, I'm looking for 10 units, like if you're looking for 10 units, it's both, right? It's go direct to seller and talk to the brokers, because the brokers and the agent, they spend their lives building those relationships. So if Whitney, you're looking for 20, and I know you're not anymore, but if you're looking for 20 units in, Indianapolis, and you've been building a relationship with a broker for 6 months, 9 months, 2 years, and that broker knows that you're looking for 20 units built between 1990 and 2010, and he has lunch with a guy who's like, I think I might sell my property. Whitney's been looking for that, right? He's going to call you first. You get that deal before anyone else sees it.
For sure. Tell us about, or maybe walk through the exit plan a little bit with that bridge debt on that project.
So we're in the process of leasing up those units. The fire marshal took like 4 weeks to come out and do the inspection. Like everyone's just sitting there twiddling their thumbs like, dude, like, can we get the COs, please? So not surprisingly, that got delayed. So the plan is to lease those 20 units up quickly. And then all the rest of the units, we're doing light renovations, and then we're adding some amenities and light stuff on the exterior. The rents are, I'm getting deal merged right now, but I think the rents are about $170, $180 below today's market where they should be. So the plan is in 18 months' time, we'll immediately get those 20 units leased. And we're also doing light renovations on all the rest of the units, bumping the rents on those. And then ideally, sometime between month 18 and 24, yes, refinance out of that bridge loan. But again, if it takes an extra year, that's okay, because we got that initial 3-year term. Hopefully it won't. But if it goes to plan, we'll be out in 18 to 24 months. Put a different kind of debt on there, probably agency. There is agency debt without prepay. If you go like a floating rate that has it steps down, you can often prepay it within year 2 or 3 without a yield maintenance penalty. But we'll evaluate what the market looks like there. And then the plan is to hold it for a total of 5 years.
Nice. And for the listeners too, what's a yield maintenance penalty?
Yeah. How they calculate it, it's literally like calculus. It's crazy. I got them to send me this. I'm like, no one can tell you. Like, well, how much is it going to be? No one can answer that question, right? It's like, well, it depends on this and this. And I finally got a sheet one time on how to calculate. It was literally like, if you remember from high school calculus or college, like
I don't even want to think about it.
Yeah, like all the crazy Greek letters and these formulas. Like, oh my gosh, no wonder no one knows how to answer this question, right? So yield maintenance can come. I'm sorry, actually, what was your
the yield maintenance penalty? Just like, what is that?
Oh,
why would that come into play?
So what it is essentially, the agencies, like Whitney, if I loan you $100,000 and you say, hey, Andrew, I'll pay you 7%, and you pay me the 7%, and then you do whatever, and then you pay me back. I'm like, okay, cool, right? It's my money. Well, what the agencies are doing, is they're selling that debt on the secondary markets, and it's getting packaged up in securities and all that. And so when that happens, they have to essentially guarantee a certain yield to the investors that are buying that debt on the secondary markets. So that means if you pay off your loan early, it screws up those securities that they made. And so how they fix that is they say, okay, you can pay your loan off early, but all this yield that we're not going to get because you paid off your debt early, you have to give us that so that we can give it to our investors. And what they do is they say, well, okay, you're paying this loan off early. They say, well, okay, we can if rates are lower, they're going to come back and say, well, yeah, we're going to reloan this money, but we're going to get a less of a rate on it. So you have to make up the difference because you're the one paying it off early. So give us $500,000 and we'll go ahead and call it good, right? If rates are higher, let's say they loaned you the money at 3%, and now they can loan it back out to somebody else at 4%. They're going to say, okay, cool, we can loan this at a higher rate, but yeah, you're still paying us off early, so you're not going to owe us as much of a penalty, but you're still going to owe us some. So that's basically the idea is when you get that loan, they're counting on making a certain yield from you because you borrowed that money. And so if you pay off early, they want you to maintain that yield for them, even though you paid off that loan.
No, I appreciate that because some of those terms we hear often, and I just want the listeners to understand as well what that means, and they can get their what's old graphing calculators out or the big company.
TI-85, man. I still have mine.
Have to get their TI-85 out to figure that out.
I haven't heard anyone bring up one of those in a long time.
So I want to shift gears just a little bit because I know there's many questions that you and I both get around, the current market and the economy and picking markets, things like that. So I want us to have a few minutes to discuss that. So tell us right now about, are you buying? Obviously we know you're doing some buying, but what's your philosophy right now for just the state of the economy and buying, selling, picking markets? Let's go through some of that.
Yeah, we are net buyers. Although with that said, we have taken some chips off the table in 2021. As far as picking markets, I'd say it largely depends on your goals as an investor, right? I mean, if you're going to invest in your backyard, then now you're talking about picking submarkets or suburbs or something like that. However, I would encourage everyone, don't be limited by geography and just, it needs to be close, because that's definitely not true. My philosophy is live where you love to live and invest where the returns are the best. So in terms of picking markets, with multifamily of any size, you want to start with fundamentals, population growth and job growth, right? And if you're like, well, okay, that sounds great, but where do I start? The Harvard Center for Joint Housing Studies produces a fantastic map of the entire United States where you can go on there and by county, it's color-coded in blue. They show you every county in the U.S. in the population growth. So if you have no idea of where to start, go to that map and start in the areas that are dark blue, right? Because the number one driver of multifamily rent growth and high occupancy is population growth. Because even if someone's going to buy a house, I forget the number, but something like 80 or 90% of people, when they move to a new market, they will rent first, right? So if you're in an area with strong population growth, a huge rising tide or tailwind or however you want to phrase it. So that's number one.
Tell us where to find that report again.
If you Google it, it'll find it, but it's Harvard's Joint Center for Housing Studies, I believe. And it's a map that they maintain. And you can zoom in, zoom out. You can pick counties. I mean, it's fantastic.
We'll try to link that in the show notes. But go ahead, number 2.
Yeah. Number 2 is median income. And I recommend don't use a radius. You actually drill down to the submarket and zip code or even block level. And we like areas where the median income is generally $40,000 and above. But the key is you want to make sure whatever rent you are charging is going to be affordable to the majority of people in that area, right? So what does affordable mean? Generally speaking, someone can spend 25% or less of their income on rent. So if your rent's going to be $1,000 a month, $12,000 a year, you want the median income to be $48,000 because $12,000 is 25% of that, right? Now, is it a hard cutoff? Absolutely not, right? If it was 45 or 40 even, and it's a otherwise great deal, yeah, you still want to consider doing that. But those two things are going to give you the greatest chance of success on making sure that the vast majority of the market can afford to rent at your property and still cover a flat tire and not get late on rent, right? And that tons of people are moving in. And there's a whole long list of other things we screen for beyond that, but those are the two primary factors that you want to look for in terms of picking a market. And if you do that, you're setting yourself up where the odds are much more in your favor of having success. And yes, those markets probably are going to be a little more expensive, but that was actually, my first deal. One of the reasons I bought it 10 years ago is because it was cheap and I could afford it. And that's actually a mistake. When I look at, the 2,600 units we've done, like when I look at right now, the most successful deal in terms of equity multiple, profit, all that is actually the one we paid the highest price for. So buy the right asset in the right market, and that sets you up. Now, as far as, prices are super high. Are you worried about things coming down? There are headwinds. We're definitely watching interest rates, how high those get. But unless you're short term, it's really tough to think of a better asset to be in than multifamily, right? We have a chronic housing shortage in the U.S. That is not changing. We have wage inflation, which means people can pay for higher rents. We have commodity inflation, like through the roof, right? Well, what is an eightplex? Well, it's a package of commodities. It's wood, it's copper, it's steel, it's all these things that are going through the roof. So the cost of that asset is going up. As the dollar devalues, it's going to take more and more dollars to buy a piece of real estate. So, in hard assets like apartments tend to do really, really well in inflationary environments. Also, if you take a long-term view, I think we talked about this earlier, as long as you have the underwrite to enough cash flow that you can hold on to that property through any dips that inevitably will come, long term, we're a big believer in housing, single family and multifamily.
I wish we could continue this conversation a lot longer. Unfortunately, we just have a couple minutes left. So maybe just a 30-second answer on the next few questions, because there's a couple things I was really wanting to get to, but it's just been a great interview. But tell us, what predictions do you have, for the next 12 months? And you only have about 30 seconds. So.
Fed will hike maybe anywhere from 3 to 6 times. We're underwriting 6 just to be careful. Rent growth 2022, maybe 4 to 6%. I think it'll cool off years after that, which is a good thing because the current increases are not sustainable. Multifamily pricing will rise in 2022, but not nearly as much as in 2021. And I think it'll flatten out for a few years after that, which again, I think is a good thing, kind of let the market breathe and catch up.
What are you doing different right now, or are you doing anything different right now as far as preparing for a potential downturn than maybe you were doing 2 years ago?
Yeah, a few years ago, we basically just almost always went with the fixed debt and we're going to sell in 5 years or whatever. We are being much more cognizant and proactive about setting ourselves up to have flexible exits in case we are in an adverse market when it comes time to do so.
Yeah, great show for this too, talking about debt and thinking about planning for that on the front end, right? And so tell us, what's your best source for meeting new investors right now?
So we track that. We look at that every quarter. Our number one source is referrals. So existing investors referring friends or family or whatever. And then second is having conversations like this, actually. And people say oh, hey, I'm going to check that guy out or something like that. So in order to get on our investor list, you have to fill out a short form and then do an interview and call and all that. But on that form, one of the questions is, well, how did you hear about us? And so then that feeds into the database. And then once a quarter, our virtual assistant tallies that all up and sends me a report.
Nice. Is there a specific system you use or CRM that helps you with that?
I use Salesforce on the broker side, and then we use IMS and Kajabi and MailChimp for the investor side. I'm not personally involved in how they set up those forms and all that. So that's again I finally outsourced that.
Good for you.
I don't know how to set up MailChimp forms. I'm gonna bring someone who does.
I get that question often, what do you actually use? What system? But what about a couple of daily habits you were disciplined about that have helped you achieve this level of success?
I have pretty set routines. I try to go to bed by the same time every night. Sleep is an absolute top priority no matter what is going on. Exercise is the same thing. Almost never miss that. So those two, and then also trying to focus on, we talked a lot about relationships, but making sure personal relationships are good first, because it goes back to, if anyone who used to work in the corporate world, who's the guy who's doing the worst job? The guy who's in the middle of a divorce because he's fully distracted, right? Understandably. And so focusing on my marriage and the kid, all of that stuff is good. And then it's so much easier to be present and productive in business and everything else.
Love that answer. I could not agree with you more. And I would even extend that to your team members. Think about even asking some questions of them sometimes or encouraging them to think that same way. It's only going to help your business, right? If they're not distracted like you're talking about. What about, how do you like to give back?
Yeah, we're connected with a lot of charities at home. I'm not good at giving of my time. That's a goal to improve. Most of our giving is financially at this point. And actually, one of the ones that we added significantly this year was for people trying to do adoptions, which I know that's something that you focus on a lot. And that was super cool. We actually helped somebody out and we got an email and they're like, I feel really bad about this, but do we know you? We're like, no, you don't. We just really liked your story and, have a heart for this. And we're not, me in particular, we're best suited to help people adopt and to not actually do it ourselves. That's not my skill set, but some are doers and some can be enablers. And so it's like, as long as that kid gets a better life one way or another, then hopefully that's making an impact.
I appreciate you sharing that. That's incredible. I look forward to hearing more about that, obviously, personally. But Andrew, it's just honored to connect again in person, even here at GoBundance. Again, grateful for the opportunity to do some in-person interviews here. Grateful to connect. Just a great show and thinking about the debt, thinking about our exit plan and how those things are connected in a big way. Are we planning long-term when we're thinking about that debt on the front end? What type of debt? And even the terms of that contract, like you're talking about, hey, they are negotiable. We can go and say, this does not make sense, right? So just grateful for your outlook on the economy and just predictions that you have for this next year and how you're giving back as well. How can the listeners get in touch with you and learn more about you?
Well, I guess you could join GoBundance and we'll meet in person. But no, the easiest way is just our website, Vantage Point Acquisitions, or VPACQ.com. And there's tabs on there that, connect and, you'll come to my inbox and happy to have a conversation or connect on LinkedIn. If you do connect on LinkedIn, send me an email through the website, because LinkedIn, I seem to get spammed like crazy. So I actually don't really read those messages. So please do connect in the real world. So
Andrew, thanks again. Hope you have a blessed day.
All right. Good talking to you, Whitney. Thanks.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the #1 resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.